Welcome to our 13th lesson. We are now ready to get started with it, so let's proceed. And by now you are probably, or you should all be familiar with the disclaimer, so I will just remind you to take a few moments always to read it. All right. Today we are going to talk a little bit more about transitions in the market, transitions in control, and then we are going to talk a little bit about the fractal nature of the market and the fractal nature of the concepts that we've discussed regarding the profile. And then we're going to get into a brief look at some of the traditional technical indicators that help us in determining more precise, more accurate entries, and also help to give us a confirmation regarding some of the ideas that we may have about the market. So today we're going to talk a little bit about moving averages and the Keltner channel. So that's what we have on the agenda for today, and let's go ahead and get started with transitions. Identifying transitions is a very important skill to develop as a trader. The market never continually moves in just one direction. It's always changing direction, and it's always going through different transitions, even within a trend. It never continues to move up all the time, or down all the time, or sideways. There are always these transitions. Being able to identify these transitions is a very important skill. It is very important for two primary reasons. The first of which is it really helps us to identify trade opportunities. Transitions are the best times to figure out which way the market is going and then try to participate in harmony with it in the direction that it wants to go. At the same time, if I am in a trade and I'm managing my trade and I begin to see a transition taking place in the market, then I know what to do, whether it is to add to my position or whether it is to get out of the market, but it also helps me to manage my position as a trader. So these transitions are very important for us to be able to identify, and we've already talked a little bit about the idea of market transitions, the types of market transitions that we can have between a one-sided market and a two-sided market and so on. Today we're going to work together to develop the skill of first identifying these transitions and then learning what to do when these transitions do in fact occur in the marketplace. Let's begin by taking a look at a structure of a standard trend day. By now, I hope that you would all be quite familiar with this structure and you would be able to readily and easily identify it by its characteristic features. First of all, it has a wide range and it has a rather narrow TPO structure, and it is directional in a sense that the range extension is all taking place in one direction. So by now, for us, it should not be hard to identify a standard trend day. You will notice that even though this was a strong directional day, we did have a number of transitions throughout the day. So let's take a look at how the day developed and how we could learn to identify where some of these transitions are and what our reactions should be when we encounter them. The first thing I want to do is I want to split the profile for you because that will help you see the transitions a little bit better. We had a transition in the directional move up here. Let me grab my highlighter. If we take a look at this area, we can see that in fact we did have a transition here. The market didn't continue to move up directionally as it had done during the prior three periods. All of a sudden we saw a rotation develop. And then the market started to head back up again, and then we experienced another transition here. If you notice, we didn't continue to have higher highs or higher lows. On the contrary, we started to get a lower high and a lower low. Now, when I see this, does this mean the market has changed direction? Well, the correct answer is we really don't know yet. We don't have enough information. And what we want to learn is to be able, one, to identify these transitions, and then two, to get a better feel on what these transitions are telling us so we could react accordingly. And we need to look at some other tools rather than just a split profile to help us. So let's begin by looking at another very powerful tool that we have in our toolbox, and that is the bar chart. And the first thing that we want to do here on this bar chart is to identify all of the different transitions. There is no question in our mind that in fact we did have a directional day. And by the way, this is the same exact profile that we just looked at. It's the same exact day. So we know that this was a directional day. And it's not difficult to see this. Look at the up movement for the entire day. Prices were moving in an upward direction. But even though that were the case for the majority of the day, we did experience and we did encounter a number of transitions. Let's begin to identify some of these transitions. The first one began to take place right here. So we had period A, period B, and period C, basically all directional. Period D came along and also continued in that same direction. So basically, A, B, C, and D was all one time frame control. The other time frame buyer was in control of the market. All of a sudden, take a look at what happens at period E. Period E, the high for period E is lower than the high for period D. The low is still higher than the low for period D, but we certainly see a couple of things that would indicate for us that a transition has occurred. First of all, we're starting to see more red in the bar. Certainly, relative to the number of boxes that we have in the footprint bar, there are more red lines than there are green. And in fact, if we do take account, 1, 2, 3, 4, 5, 6, I have 6 red to about 4 green. So I'm not completely dominated by the red yet, but I'm certainly seeing a transition. In addition to that, the next clue that I have, take a look at the extent of the range. First of all, the range for E is a much narrower and smaller range than D. It is a little bit less than half. Another indication that we're in a transition, look at where most of the trading activity is actually taking place. It is taking place in the lower end of the range of D. So all these elements combined together now highlight for me that control has transitioned from one time frame control to two time frame control. The first question that we need to address is, what is the extent of this transition? How long will this continue to happen? Will this change the next half-hour increment or not? And the answer again is we really don't know. Now, certainly it is giving me a hint that there's a transition. Does this mean that it's time for me to take a short instead of a long? That would be a very dangerous conclusion to make. You never want to react prematurely to transitions that you see in the market, especially if you've already identified that the day's structure is a directional day. One recommendation I will make for you, and this is a recommendation that I will hope you will always heed, whenever you have a directional day, avoid taking any trades in the opposite direction. Yes, I know that the transition tells us that we're going to have a change, and in fact we do, and prices do drop a little bit. But the drop is so insignificant compared to the profits that you can make in taking trades in the direction of the market that I would forego that trade. This would not be a trade that I would encourage. Now, at some point in your trading career, when you have really mastered all the techniques and you just want to capture a few ticks here, and you know that the market is likely to drop and you're going to capture them, you may do that. But for me, the risk of doing that relative to the gain is really not worth the trade. This is not a trade that I would recommend. On the contrary, what I would now be doing, knowing the structure of the day, is I would begin to look for when will the transition come back into the trade of the day. And that's the high probability opportunity that I would seek as a seasoned trader. Why go after the difficult trades? Why not take the low-hanging fruit? It's always smart to make life easy for ourselves rather than more difficult. So even though you will have accurately identified this transition, and yes, prices are likely to drop a little bit more, I would not use that as a way to take a quick short. I would actually use this as perhaps an opportunity to exit a long position that I've had. If I have been if I followed some of my other earlier signals for the day, identified the structure, and I'm in this trade in a long position, and I see this transition take place here, then I may take my profits and stay out of the market until the market changes direction back again into the direction of the day. And you will see this will not be difficult for us to identify now that we know how to identify transitions. I'm going to repeat for you or re-emphasize for you the three key things that highlight for us that in fact we have a transition. Notice the lower high on E from D, increased activity at the lower end of the range, so the market is really starting to facilitate trading to the low side, and an increasing number of red boxes in period E. This identifies for us that we are now in a period of transition, not necessarily change in market direction. As a matter of fact, never be hasty thinking simply because you have a transition that you're going to get a change in market direction. Now we have another transition that begins to take place. Sure enough, the earlier transition brought prices down to here, but now begin to take a look at what's happening again. The transition is now taking place from a 2-time frame trade where the short-term traders were in control trading back and forth together to 1 time frame again. What's happened at this point is the other time frame trader has decided to step back into the market. And remember, this was already a directional market that we had identified, and prices started heading higher. At this point, this is when I recognize that I have a high probability trade on my hand, and even if I would have closed my position up here, I would be willing to start a new position and move up again directionally with the market and take my trade in the direction of the day. Again, a very important rule on directional days: always only take trades in the direction of the directional day. You will save yourself lots of headache doing that. Do not try to capture these small or minimal transitions. They're just not worth it. You have high probability trades. You have great opportunities. Don't abandon those for the risky ones. Now, why is this happening in the market, and why did we get this transition? There are really a number of reasons for it. First and foremost, we have a lot of longs that are actually selling. They've captured this move, and now they want to capture their profit, so they're getting out. And as they get out, there's selling that takes place. When the other time frame trader notices this, they decide, well, gee, I know that I'm going to be buying because I'm going to push the market a little bit higher. Why not buy at the lowest price that I can get? Let these guys sell all they want, and I'll buy from them. So when the selling begins, they begin to pick up the prices or the instrument at a bargain, and then at some point when the selling stops and the people have captured their gains from the initial part of the day, then the other time frame trader begins to continue their push forward, and they begin buying again, and we find that prices start to move up. Often in technical analysis, this is what is described as a retrace in the market. The market retraces. But it's important for you to understand why the retrace is taking place, because many traders are in fact cashing in on their gains. They're selling to lock in their profits. Now, unfortunately, there are also many amateurs that begin to see this selling, especially when they see a big red candle like this, and they think the market has reversed. Aha, this is my opportunity, and they jump in on the selling as well, only to discover that the market is going to turn around and head back in the direction of the day. So you certainly don't want to be one of those amateur traders, and you need to be able to recognize and understand what's happening in each transition. So now we've transitioned from 2 time frame to 1 time frame, which means that we are back in the direction, and this would be a great trade to get into at this point. Once again, let's cover the characteristics that tell us that another transition has in fact occurred. We see that we have a higher low. Take a look. This low is here. This low is higher. So now we're starting to move back in the direction of the market. Look at where the increased activity is in the bar. The increased activity, look at the numbers, they're starting to occur on the top of the range. Another indication we're heading up. There is an increase in the number of green bars in the footprint itself. And in this case, you notice how the buying has now started to dominate, and you can't forget this is the direction of the day. So look at the striking numbers, how much larger they are. And here now, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 green boxes to only 2 red boxes. This is a signal that we are in fact going higher. So keep an eye out for these important signals in the market. Now we have the last transition that we're going to look at that took place during the day, and in this transition we see two-sided trading taking place. The directional move has stopped, and we notice that we're not really making any new highs anymore, and the range is not being extended. If anything, the range is starting to drop when we get to period M. So now we've moved from one-sided again to two-sided in this area, and on it would appear as a consolidation, or an area of distribution is starting to develop. And naturally, the question is, do I now begin to take a short? Well, again, no. The day is still a directional day, and the market has not really given me any strong reversal signals yet, and therefore if I had a position, I would close out this position, a long position, take my gains, and I would sit out until I can sort out what is going to happen after this transition. So make sure that you understand the difference between a transition and a change in direction. We don't see a change in direction here at all. All we see is a transition. Even though we do have a range expansion to the low side, but if you notice, it's just a very minor range expansion to the downside. And if you look at the last bar here, we still did have a significant amount of buying. All right, now I want to look at this same chart, the same exact day, but on a different image. This is a footprint chart again, but this time the footprint chart is really displaying for me a profile. And I wanted to show you this because there are many different ways that we can identify or visually interpret the information that we have. The bar chart, or the footprint bar chart, is one of those tools. we can also display a footprint chart simply showing us a profile, as you see here on this chart. And take a look at what the transition looks like on this chart. Some people prefer this visual interpretation. Others prefer the earlier interpretation or the earlier visual representation that we were looking at of an actual bar with the numbers. This becomes really personal preference, but at least you should recognize the different patterns when they occur in the different forms. And you may choose actually to be looking at both at the same time. Nothing would prevent you from doing that. So here's the transition again that we looked at earlier. You can see how volume is being facilitated towards the lower end of the range of period D, indicating a transition. No longer is our range expanding to the top side, and it looks like we're consolidating here. And you can also see the dominant red bar at the bottom here on this footprint profile, showing that most of the volume was negative to the downside or in the lower range of the period. And sure enough, it was followed by another period where prices continued to drop. But take a look at what happens here, and visually now you begin to see, and I'm going to go on to the next chart so we can focus on this next transition. Take a look at the transition. It's almost like a flip-flop. We had red down here, and now all of a sudden, look at the green. This is a very distinctive transition pattern. Prices and volume are moving to the top of the range, and we're really seeing the market facilitate trade to the upside and very little to the downside. So once again, this would indicate to me a transition in the direction of the market, and this would be a good time to enter a long position in the market. And the market continues on directionally. You always have to remember you're doing this in the analysis within the context of the analysis that you've made for the entire day, and you've already recognized that this is a directional day, and your high probability trade is always taking a trade in the direction, and therefore a long is always the position that you want to have when you have a upward directional day. Now let's take a look at the last transition up here and see how it manifests itself in the footprint pattern or in the profile pattern. If you notice, we began to see some red appearing at the top, indicating some selling is beginning to occur. Then it was followed by some green in the same area. So even though we did get some selling, the buyers were still buying at this point. If you begin to see what's happening, we're developing a little bit of a value area or a sideways range, if you will. And then we began to see prices dropping a little bit, so we're experiencing a little bit of a transition, but nevertheless, I see a lot of green, and I don't see increasing shades of red to the downside. So all I would know is we are in a two-sided trade area here, or transition. It certainly could end up heading back up once the market opens the next day, or if I begin to see other signals that things are changing, prices could go lower. So I am able to identify a transition, but I'm not really able to identify any strong directional bias as a result of that transition. All right, so hopefully now you have an idea about how to identify these transitions and how to look at them or to look for them in a variety of different formats, the bar chart or the footprint bar chart. Now we're going to talk about a slightly different concept, but it also will tie into our discussion of transitions. What I'm going to talk about now is the fractal nature of the market. And let's begin by discussing what we mean by fractal. Fractal is really a term, a mathematical term, that comes to us from geometric patterns. Whenever you have a pattern and you split or break up that pattern into smaller parts, and the smaller parts end up being exact copies of the whole, this is known as a fractal pattern. The market is fractal in nature, and the concepts that we have discussed for the profile are also fractal. And let me elaborate what I mean by that. Even though we've been looking at them in the context of a full day or in the context of a half hour, if we drop down to smaller time frames, smaller increments, the same exact concepts still hold true. So we now need to begin to take a look at each of these elements and break them up into parts and see how this can further help us in identifying transitions and in learning more about how the day is developing. So once again, let's take a look at the same exact day that we've been looking at together, the same directional day. And we have a split profile for this day. So it starts out with period A, period B, and then period C. And we know from studying the profile that each of these periods represents a half-hour segment. Now, as a result of this fractal nature of the concepts that we've discussed, I want to now begin to put a microscope, if you will, on each of these half-hour periods. So this is the same exact image that we were just looking at. Go back to it. So here's my split profile, but now I am going to look at it with a microscope. Each of these periods is still a half hour, and so this is a glimpse of what happened during the half hour, a small mini profile, if you will, and each rotation in this profile is really 5 minutes. So I've broken up my half-hour increment into 6 pieces, and then I want to look at what it looks like in terms of how these 6 pieces developed in the half hour. So let's begin with just period A and take a look at A period, the first 5 minutes, and then B period really was the second 5 minutes. C period was the third 5-minute increment. D period, prices dropped down here again, was actually my fourth 5-minute period. E, my fifth, prices started moving up. And then F, prices started moving even higher and higher. And it gave me a shape of a profile. If we look at this little mini profile and begin to apply some of the basic concepts that we've learned about the profile, we can extract quite a bit of information. First of all, the shape of it. It is beginning to show a long, narrow profile, and that is typical of a directional market. Now, even though this is just a tiny little segment, it begins to give me a better idea that I would not be able to just discern from looking at period A from just this column of letters. I now have a little bit more information. The shape of the profile that made up this period A. Now when we go to period B, the same thing happens again. I get another profile, and I get a new value area, and I get a whole bunch of new information. This information becomes more and more valuable as you learn how to interpret it. So let's begin looking at it in detail together. We know already that we have 6 5-minute rotations, and each rotation relative to the one before it gives us a little bit of information in terms of directional movement and whether we're developing higher highs, higher lows, so we have a directional movement, or if we're in fact just consolidating and getting more and more prints in the same value area. The first thing that I want to focus your attention to is easy, and it is just a matter of looking at the POCs for each column, if you will, or for each 30-minute period. Because now we can see, rather than just one POC for the entire day, I can now see a POC for each half-hour increment of the day. And if you notice, it is very easy to identify the step pattern that the market is moving up simply by just looking at these POCs. It can't be any easier than that. When I begin to see POCs developing higher and higher, it is a clear indication that I am in a directional market. In addition to that, I am seeing that the profile patterns themselves are long and narrow and showing an imbalanced market that is likely to continue even higher. And sure enough, it does. And if you take a look at the sequence of POCs, with the exception of this area here where the POC is indicating a transition, when the POC does not move higher or lower, this is a clear indication that we have two-sided trade in the market, and that in fact we are getting a period of consolidation. Value is just remaining at this level for a while. We get a drop, but one drop does not a trend make. It is just a single period that dropped. This is just to sort of deceive the amateurs. We know that this does not mean a reversal in the market. We have a strong directional market. And even if it were, I would wait for a confirmation. We do not get the confirmation. On the contrary, notice what happens here. The POC starts to move back higher again. Higher yet, we experience another period of consolidation, and then the POC continues on, and then back again we see the POC leveling out, and if you notice, another value area developing up here. I hope that you are starting to develop an appreciation for how this fractal nature of the market works and how it really helps me to break things down into smaller pieces to get a better glimpse and a better feel on what's going on in the market. All right, the next thing that we want to look at together, we've looked at the POCs, we want to look at the value area. What is happening to value in the market? Are value areas moving up? Are they expanding? Are they contracting? This is all very valuable information to anyone who understands the profile. So let's begin to see what is happening to value. First of all, we begin with period A and take a look. This is where our value is for period A. Now let's take a look at what happens for period B. All right, the first thing we know right away is value has moved up. In addition to that, the value has not really shrunk that much from A. It is still close in range to period A. So the market is comfortable in this new expanding range. Value is just increasing in the range in the market. Now look at this, even greater expansion of value. So it's a very strong indication that we are in a very strong directional market and prices are going to move higher. And sure enough, we begin to see the market facilitate trade even higher yet. Let's keep looking at these value areas. Our first transition. And notice now how we can identify transitions easily and quickly on this type of a chart. First of all, look at where value is for period E relative to period D. Well, value has in fact dropped lower. Now, this is a definite sign of a transition. Again, is it a sign of reversal? Absolutely not. It just merely tells me that there's a transition in the market. Let's proceed on to see what happens in period F. Well, value even drops lower again. Because of the nature of the structure of the day, again, I would never interpret this to be a reversal in direction. It's merely just a transition or a retrace in the market. And now look at what happens at period G. Value begins to trade again a little bit higher. And we begin to see that value even trades higher and higher. It does not move lower. It moves higher, an indication that we are now moving back in the trend of the day. And this would be a good point to enter and take a long position. We now have confirmed that, in fact, even though this really was an early confirmation, I would be very comfortable taking a long position in period G even before we get to H. But this is an added confirmation for you. Now, we take a look at I, and value has really stayed consistent in the same range pretty much. We haven't moved up significantly. What this begins to tell me is perhaps the movement for the day is weakening a little bit, but it doesn't really tell me that it has ended. And sure enough, as we continue, we will find that value did move to the upside. But notice now, the range of value is starting to be smaller and smaller. Another indication that the momentum of the directional move is decreasing. Once again, we continue upward, but now I would be more conservative, more cautious. I would not be as bold as I would have been in perhaps a large position early on in the trend. Now I would be far more conservative, and I would be looking to capture my gains as quickly and as early as possible, because I am seeing that the value really is not rapidly expanding in the market. On the contrary, it seems to be stabilizing at this level, and so it does not really behoove me to continue with a long position, being a conservative trader. I can always get back into the market when things change, but you have to gauge what's happening at each particular moment. And again, we end up with another two-sided trade up here. It could very well be that this is just another retrace in the trend. So this was one, and then we had a move up, and this is another retrace, and we are going to continue to moving up. That's very good possibility that that may in fact happen. Since this is the end of the day, though, I would feel more comfortable, and certainly the more conservative approach would be to capture your gains and begin fresh on the next day. All right, now I want to direct your attention to another important element that we want to look at and study on this fractal or this mini profile chart. The opens. We've learned a lot about where the open occurs relative to the value area of the prior day. Now let's think of it of just the prior period. So take a look here, column B, the open in fact opens higher than the value area but within range. And what happens? We have an open test drive. We come back down, we test the value area, and we find support. Continues on higher and higher and higher and so on, and then the value area begins to develop above. Let's take a look at period C. And here we open above value, and take a look. We had a minimal test, just one print below the open, and we take off like a rocket, and the value area begins to expand. All right, now we're going to take a look at period D together. This open relative to the prior period. Once again, we open above value, and we're opening in towards the high end of the range. All of these, you now know from learning about the profile, are indications of a very bullish trend or a bullish direction in the market, an upward direction. And take a look at period A, how it shoots so much higher. The reason by this point and why this tends to occur is everybody at this point has figured out that this is a directional market, and you have a lot of the amateurs getting into the market at this point. And sure enough, as soon as they do that, this is what the professionals do to them. it's time for the retrace. It's time for them to take their gains. And then really these guys then find themselves, oh no, what happened to that bullish movement that I just finally figured out the market is going up? I made a mistake. And then they begin to sell, their stops are killed. And then sure enough, here's what the professionals do. Then they begin to take the market higher again. It happens, folks, every day in the market. It's sad, but that's why so many people lose. They just wait and wait and wait. They don't take the entries at the right time. They don't understand market structure. And by the time they get the confirmations and all the candles look the way they should and so on, and then they enter the trade, it's a little bit too late. And the professionals know that. And when they see them coming, and this is why all of a sudden, take a look at how high A period, the very first period in D went up, because this is all of the amateurs now jumping into the market and the pros selling to them, taking, okay, you want to buy it at this price, here you go, we'll load you up. And sure enough, the market then starts to drop. Those who have the wherewithal sit it out and wait, and then the market takes them back up again. But this is the worst time to get into the market up here at these points. This is not the best place for the entry, and that's why we learn to study the profile and we learn to analyze the market so we can be choosy and we can pick our entries. As a profile trader, this would be the time you would want to enter the market. And certainly if you weren't able to get in at this point, this is the point when you should have been in. So you're in the market an hour earlier than the amateur. And once again, you're not deceived by the retrace, and you don't think that this is the end of the move. On the contrary, you sit this move out, and then you begin to participate in the move once again, once it starts later in the day, and then you take it up directionally. So taking a look at the open of each period relative to the open of the prior period is very important from the perspective of a profile trader. Take a look at each of these opens. Now notice here, when we had this retrace, we had lower opens, and then all of a sudden, take a look at the big jump in where this open is relative to this one. Another clear indication for you, things are starting to move back in the direction of the trend of the day. And sure enough, the opens continue to move higher and higher as the day progresses. All right. Now, when we enter this period here and we begin to experience another transition, take a look at what happens to the open again. All right. It's still a little bit higher, but what's happening now is the value is dropping lower. These are the kinds of things that a profile trader keeps their eye on. Where is each period opening relative to the period prior to it? Where is the value area relative to the period prior to it? And where is the bulk of the trading taking place during each period? Is it at the top of the range? Is it at the low end of the range? Where is it? Where is the market facilitating trade? These are the telltale signs that tell us exactly what's happening in the market as it happens in the market, and we need to be very attentive to them. And I hope that you will now start building and using these 30-minute mini profiles in perfecting your entries and exits from the market. In addition, of course, to using the daily profile to give you an idea about the big picture and the structure for the entire day. All right. The last thing that we should not ignore, and we should also keep an eye on, is, of course, looking at the shape of the profile. So we've already looked at the POC and the direction of the POC. Are they going up or are they heading down? We've looked at the value areas, whether the value is moving higher or lower, and we've looked at the value range itself. Is it expanding or is it contracting? And if it's contracting, it's telling us we are heading into a transition, or in fact, the momentum is slowing down in the market in the direction of the trade. We also looked at the location of the open relative to the period prior to that. And certainly, we have not talked much about the close yet, but definitely you also want to take a look at where the close is for each period relative to the prior period. We're going to talk a little bit more about close and closing ranges and so on in a future lesson, but I just also wanted to highlight for you that that is another thing that you will be looking at. But for now, we're trying to use some of the concepts that we've already learned. So let's take a look at the shape of the profiles. Each profile tells us something about the period. Once again, a skinny, narrow profile is indicative of a directional market. When we start to get a chubby, short distribution, then the market really is consolidating in this area and we're getting distribution. Once again, we have strong directional market, that long, narrow profile, very directional. Here, what we had is really what we would describe as a neutral period. Very wide range, and then all of a sudden we began to trade in one part of the range, and sure enough, it did end the directional move for a little bit. So if you're able to identify that this was in fact a neutral day, you can see that you're heading into a transition, that no longer was the market facilitating trade or moving directionally as it was in the prior three periods. Here we continued on with what we would describe as a non-trend day, and even though I'm calling it a day, I am only doing that to bring back to your mind the patterns that we've studied for the day. We are not really looking at any days here. We are only looking at half-hour increments, but we are using the same concepts that we've learned about the profile for an entire day and applying them to a smaller period of time. So I will now begin to use the word period more than I will use day, so as not to confuse you, but I just want to make sure that you understand the fractal nature of the market, and that in fact these very same concepts that we have discussed vis-a-vis the day do in fact apply when we apply them to shorter time frames. If the period is 30 minutes, they will apply. If the period is 1 hour, they will still hold true, and we can still apply them. The one thing that you need to recognize, though, it is difficult to really get a lot of meaningful data and information if we start to go very, very low in terms of our patterns. And let me explain a little bit more what I mean by that. We're looking now at half an hour. Okay, you might say, well, why don't I get even more detail by looking at a 5-minute profile, and then I will use 1 minute for each of my periods within the 5-minute. It begins to get too noisy and you don't get really any meaningful data. I'm going to tell you that 30 minutes is about the smallest period that you can really get anything meaningful out of. And 30 minutes using 5-minute periods to make up the 30-minute. Even if you use 10 minutes for the 30 minutes, you're not going to get as good a picture as the 5 minutes. You can go to an hour, and if you go to an hour, you can change that formula a little bit. But based on my experience, I've always liked the 30-minute, 5-minute development, and that's what I recommend for you to use. Certainly, you are more than welcome to experiment with others. Once you have the idea and the concept down, and you understand what we're doing, you can play with it, and you can modify it to suit the particular instrument or time frame that you want to trade. All right, so continue on to study these patterns. As you begin to see, we get a directional pattern here, and then once again we get a more of a consolidation towards the area up here, indicating really that value, is, even though it's going higher, is not really being facilitated with strong momentum as it was in the early part of the day. We're not moving as quickly or as rapidly in terms of range extensions. Okay, so now you know the 4 key things that you want to be looking at. And I want to switch gears now and begin to bring back in some basic technical analysis concepts. We have been focusing on the profile for the majority of our lessons, and we will continue to talk more and more about profile concepts. But just because we really are not using technical analysis as our primary mode of learning doesn't mean we want to throw the baby out with the bathwater. There are some very useful things that we can gain by introducing some of these basic technical analysis concepts. And one of them that I want to share with you, actually, there are several that I will be sharing with you, but one of them that's very powerful and very simple, in fact, are moving averages. We use them in tandem with the profile and the different profile concepts that we have learned. First of all, I want to identify for you 4 key moving averages that we always like to keep track of. The 8 simple moving average, the 20 simple moving average, and the 50 simple moving average, and the 200 simple moving average. Now, why these numbers specifically? There is really nothing magical about these numbers. The only reason I have selected them is because I know from my experience that these are the numbers that a majority of professional traders tend to look at and tend to use. And as a result of that, the market tends to react to these numbers. More importantly, we find that since these are the numbers that get the attention of many professional traders, quite often we will see them programmed into the algorithms that are used in the market. So they end up even influencing price action and price behavior more in the marketplace. So what do they mean to us, and how do we in fact use them? Well, first of all, we need to have them on our charts. So whenever we have a footprint bar chart, I would like you to start now using the moving averages that we have just identified. And I like to use a color code that is consistent on all my charts. It just makes it visually easy for me to identify what it is that I'm seeing. So typically, I use green for my 8-period moving average, the simple moving average, and blue for my 20, red for my 50, and black or brown for the 200, the 200 moving average. There's a lot of debate amongst traders on should I use the simple, should I use the exponential, the weighted moving average. There's so many different variations. My recommendation is stick to the simple moving average. The others are just subtle differences, and we are not really relying on them for how we trade. It's just an additional support tool to confirm for us and validate what we already know, so that it helps decrease the likelihood that I'm making a mistake, but I'm not going to really rely on them as my primary analytical tool, and therefore it really does not make any difference whether you want to use the exponential, the weighted. They're all pretty much the same, so why not keep things simple and stick to the simple moving averages? I trust that everyone probably knows how they're calculated. Basically, they take the close of each of the candles, divide them by the number of candles, and that's how we end up with that moving average. Now, let me show you why they're nice to have on the chart. We are looking at a 30-minute chart, and in this case, we are looking again at the same exact day that we've been looking at throughout our lesson for the day. And I wanted to make it consistent so that you see the same image in different shapes or in different forms, if you will, and then also you can see how it interacts with the different tools or the different indicators that we are using. Take a look. These are, again, A, B, C, D, and then E, F, G, the same exact columns that we've been looking at. But what I want you to observe is where price was relative to the 8 moving average all day. Notice how it tended to act as a level of support for prices. What I want you to begin to see is when you see that every time price came close to it and then buying started to occur, this is usually not the result of an accident. It's probably because somebody programmed an algorithm whenever prices drop down to the simple 8 moving average, buy. And sure enough, when it came down to here, they started buying. Same thing here, same thing here, same thing here, and so on. And again, so it helps us to see the strength of the move. It also forms a level of support or resistance at times. Now, the 8 moving average is an important level on trending days, but it's not on non-trending days. The 20 moving average is the one that we always want to keep our eye on. The 50 and the 200 are also important. Whenever you begin to see that the 8 moving average is above the 20 is above the 50 is above the 200, you know that you are in a bullish market. And you want to do your best to stay on the right side of the market, and you know that you will always do better with long positions rather than short positions. I can't emphasize enough for you the importance of being able to stay on the right side of the market. You don't want to be chasing after these insignificant retraces or small trade opportunities when, look, you have these beautiful big moves. These small ones will kill you in terms of losses, whereas these ones will put money in your pocket. So which would you rather go for? The big bucks or the trivial, the little insignificant amounts? And it's amazing for me always how many traders get trapped and get caught in these little opportunities. They're very clever in identifying, and by the way, the professionals make it easy for them to identify these short opportunities, to lure them in, if you will, and then it's the old bait and switch. As soon as they have them on the hook, then they take them back up and change direction on them. So you have to be careful of that. You have to understand the structure of the market. This is where the moving averages sort of affirm what you already know. So if in fact you've identified the structure for the day as a directional day, you take a glance at the moving averages. Am I right? Is the 8 in fact above the 20? Is the 20 in fact above the 50? And if in fact all the elements are in place, you have a higher level of confidence and you get in your trades with more confidence. If the pieces are not all there and something is missing, you should then take another look and restudy and re-examine, why is this the case? Why am I not getting all the confirmations that I would like to see and that I would like to have? All right. Another easy, simple indicator, technical indicator that I frequently like to use, and I will encourage you to also place on your charts because of its power and simplicity, is the Keltner channel. The Keltner channel is also a very basic tool, and it relies on 3 lines. I like to use the 20 simple moving average for the center line, and then we have an upper Keltner and a lower Keltner. The upper Keltner will be 2 standard deviations above the moving average that I've selected, and the lower Keltner will be at 2 standard deviations. Now, these adjustments, or these settings, if you will, I may change based on the instrument and the time frame that I'm looking at, but for the most part, for the majority of the things that you will trade, you will find these settings to be useful. All right, let's take a look at the Keltner channel together. I told you that we have a center line based on a 20 moving average. So this is the same exact thing as the simple 20 moving average that we've talked about. And then it has an upper and a lower line. The center line is my 20 simple moving average again. And let's take a look together at the top Keltner and the low Keltner, or the upper Keltner and the lower Keltner. Now, notice where prices are relative to the Keltner. Again, if this is an up day, up directional, standard directional day, you're going to see prices will be above the Keltner. If in fact they're trading lower, that gives you an idea that the direction is not as strong. So take a look here. We're really trading 2 standard deviations above the simple 20 moving average. Another way that the Keltner is very useful is it shows me when the directional movement begins to weaken. And the levels within the Keltner provide me levels of support and resistance, and sometimes also targets. So take a look here what happened when prices dropped to the top Keltner or the upper Keltner and then came right back up again. Very strong indication of a directional market. If in fact prices continue to drop inside the Keltner, the next target or support level that you would look at would be that 20 simple moving average. How are they going to react when they meet this level? Just added tools to help you gauge where things are in the market, identify transitions when they occur, and evaluate the type of transition that's occurring, whether the move is just weakening, whether it's just a retrace in the market, or whether in fact we're beginning to see a strong directional move in the other direction. If in fact prices started dropping, fell below the 20 simple moving average, and then started to drop even lower than the low Keltner, well, certainly now the market is telling me that things are changing, and the direction of the market may in fact be taking a complete different turn. This is how we use these tools. I wanted to introduce them to you, and then we will begin to look at other examples of using them, and then we have a few more technical tools that we will also be looking at together. And the idea is we want to have a clear picture of what's going on in the market and use all the tools that are available to us. We rely on the power of the profile as our primary source of analysis, but then these other things are the spices, if you will, or the little bonuses that help indicate to us and verify to us that we're in fact on the right track.